With interest rates going up over the past 1 year, home loan rates in India have also been climbing. Many new borrowers are struggling to meet the eligibility criteria of lenders. One product they should consider going for is mortgage guarantee. This is basically a credit enhancement product offered by IMGC in India. It can help you get access to a better quality lender, which could translate into a lower loan rate for you. It can even get you access to a 30-year loan well past your retirement age, which would in turn mean that you pay a lower EMI. To understand how mortgage guarantee works and the benefits it can offer you, we spoke to Mr. Shrikant Shrivastava, Chief Risk Officer, IMGC. Good morning, Mr. Shrivastava.
Good morning, Sanjay. How are you?
Very good. It's a pleasure having you on our show.
Sure, it's a pleasure here too.
The RBI has been hiking rates, and perhaps we are at peak rate or very near to it. Home loan interest rates have also gone up a lot in the past year or so. Therefore, we thought it would be a very good time to speak to you about the concept of mortgage guarantee and how it can help retail home buyers. My first question to you is, what is mortgage guarantee and what can it do for home buyers?
Sure. So mortgage guarantee is a credit default guarantee, which essentially means that if the borrower is unable to pay for whatever reasons, the mortgage guarantee will come in and start paying his installment. So that is broadly the concept. Now, the way the product works in several other countries, and obviously it started from the West. Availability of mortgage loans is not an issue for anybody. It is the loan to value which determines whether the lender is willing to give a loan or not, which essentially means that if the property is of 100 rupees, and if the lender says, I can give you only 70 rupees or 80 rupees, it becomes difficult for borrowers to muster in that balance 20 rupees, save that 20 rupees, and it takes a while to save a 20 rupees. Therefore, mortgage guarantee, and it is called mortgage insurance in the West because it's an insurance product. So it helps borrowers take a higher loan to value. So if the lender is willing to give only 70, the mortgage insurance company will come in and say, I will give this person 90% or a 95% because LTV is not regulated in the West, unlike in India. So with a credit enhancement like mortgage guarantee, people go up to 95%, 97% of the home loan, which essentially means that you can buy your home early. Instead of waiting for 5 years to save your money, you are able to buy it maybe in 1 year or 2 years of time since you start working.
So what are some of the things that mortgage guarantee does for customers in India?
Yeah, so we had to set this product to an Indian context. And the Indian context is this, that the home loans are available largely to formal income borrowers, which means that people who are working with large corporates, mid corporates, and also to self-employeds who are filing regular income tax returns. But as we know, that is a small 6% of the total population. Much of the population is outside this. So how do they get loan? How do they get into the formal lending segment? Because the informal lending segment, the interest rates can be as high as 24% and above. So in the Indian context, we provide loan what is called the affordable segment. People who are working in micro and small enterprises, people who are working in small shops as salesmen, people who are doing manufacturing in small scale industries, which is not formal, and supplying to another ancillary, which in turn is supplying to a large corporate or production house. So those kind of borrowers, lot of self-employed, as you know that in India, equal amount of workforce as much as salaried is in the self-employed segment as well. We have the largest self-employed base in the world. That population, a lot of them are exempt from tax, because with this year's tax changes, income up to 7 lakh is exempt. So if you had a loan income of 7 lakh, you don't need to pay a income tax return. And the tax culture anyways has been, the governance has been pretty poor, because of which people have not complied with. So it is essentially about including these borrowers into the formal lending segment, which is the banks and the non-banks. What it also does in this process is that because of our credit enhancement, because of our guarantee, assuming that a small housing finance company like Aptus, Avas, Aadhar, Vastu, there are small affordable housing finance companies. Now they charge 13-14% from these poor borrowers, primarily driven by the higher default rate, that is. But the default rates are not so high as to charge a 14% interest rate. So what we do is we take these borrowers to some of the larger lender partners that we have. Axis Bank runs a special program for affordable called ASHA, which is the largest affordable housing program by any private sector bank. So we take them there, and they definitely get 100, 200, 300 basis points lower interest rate. So it is a win-win situation for everybody. One, that he gets a loan from a bigger bank, a better brand, therefore better service, lower interest rate, etc., etc.
Does credit guarantee also increase the amount of loan that a person is eligible for? Can it do that?
Yes, of course. So primarily the reason why the segment that I defined, and let's call them the affordable borrower segment, they obviously will have a higher propensity to default, because their incomes are lower, their savings are lower, their ability to absorb cash flow shocks are lower. So cash flow shocks could be even in terms of medical emergency, health issue. Their ability to pay up the kind of expenses that medical services require in today's world without an insurance is very limited. So health, marriage, education, and various other social obligations, puts them in a jiffy, and therefore the default rates are relatively higher than the formal income borrowers, because of which lenders shy away from giving loans. Even when they do come in and give loans, the loan to value, which I mentioned, which means if a property of 100 rupees is being purchased, they would, even if regulations allows loan up to 90%. So you can give 90 rupees out of 100 to a poor person who's taking a loan less than 30 lakh rupees. But still they would restrict the loan to maybe 40% and 50% to ensure that there is enough borrower's equity and the default therefore is lower. They would also, there is a ratio called debt to income ratio, which essentially means how much income you have and how much debt are you paying. So what are all the loans that you have taken, and what is the residual income by way of which you can service the loan. Now that debt to income ratio normally goes up to 60-65% in India by some of the HFCs. For the banks, it is 50-55%. We also encourage banks to do a higher debt to income if the loan to value is pushed up by 20-30%, while we would be happy that 90% is given, but the lenders are slightly conservative. And we also push up the debt to income. Now, by pushing up the debt to income, the risk could go up, because if somebody is left with less surplus income to run his monthly budget, he would eventually default. But what we also do is we look at the total family income, because in this segment, both the husband and wife are constrained to work because of limited income that they have. In most cases, the spouse is also working. It is an informal income. Maybe she is doing some small scale industry labor work, for instance, rolling BD and various other things. We know a lot of these small scale industries, ultra small scale industries. So they work there, they work as domestics, help, etc. So those incomes are considered. Sometimes they are innovative and they do some small business as well. In their house itself, they will have a small kirana shop, or they would be trading on something. The wife would be working on various stitching work at home, various applique work, those kind of things. We also allow the lenders to consider those incomes by way of verifying whether those are being done or not, and make a conservative income. So the income goes up, and if the income goes up, therefore the loan eligibility also goes up. And behind all that, we are putting a guarantee. So we are not leaving the lender in the lurch saying you take all these incomes which may not be there as per his declaration or what you can see, what your eyes can meet. So we back it up with guarantee, and that is what we do, and that is how the loan eligibility or the loan amount also goes up by way of mortgage guarantee.
Now, what can mortgage guarantee do for people, say, who are in the middle class or upper middle class? Do you have products for them? I remember reading about some time ago, you had launched something about enhancing the age till which borrowing can be done. Normally, banks lend up to the age of 60 or so. If you could talk about those kind of products.
Sure. So there are multiple products that we offer to the middle and high income as well. First is, of course, the loan tenor. So a 30-year loan tenor, while a lot of lenders have published that they do a 30-year loan tenor, but when it actually comes to offering a 30 loan tenor, it is often there is a second level rule which says that you should have 30 years of service left for you to get a 30-year loan. Now the issue is that for me to take a 30-year loan, I have to take a loan before I reach the age of 30. We all know that with the kind of LTVs that is there in the middle and high income, the LTV is restricted to only 80 and 75 by the regulator. Which means if I'm buying a 1 crore house in a city like Delhi, which will be on the outskirts, in the satellite towns, and even if I'm a young professional, I'll have to must save in 25 lakhs to take that house. Now, despite that, the 75 lakhs becomes a significant burden by way of EMI if the tenure is, say, 15 years or 20 years. Or 25 years even. So even if I went for a loan at the age of 35 or 40, I'll be given a 20 or 25-year loan. So what mortgage guarantee does is it allows the lender to give a loan up to 30 years, even if he is not eligible for 30 years by way of retirement age. And we take that risk that in case he is not able to repay his loan post-retirement, then we will bear the installments and the losses. Now, this, of course, can be considered to be a risky proposition, but the fact is that even when the loans were given for a 15-year, 20-year period, the average period for a person to refund the loan was only 7 years. Now, with the tenures going up to 20, 25 years, it has gone to 10, 11 years. But on an average, 7 to 10 years is what it takes for a person to repay the loan. And the reason behind this is there are two reasons. One is, of course, that inherently we are credit averse as a nation. We have, the whole credit culture is new in India. And of course, the second thing is that the inflation, being a developing economy, have always been upwards of or in the vicinity of 5%. Even the target rate for Reserve Bank of India is 5%, normally, generally, even in difficult times. Therefore, there is a constant increase in income. So in the first or 2 years, and I'm sure you and I have all gone through this process of buying a house for ourselves. And we all have all experienced that after the first and the second year is tough because you leverage to your maximum. Whatever you can spare for the EMI and take the loan. But because of this salary increase, even if it is a 5%, and we have taken data on the government side in the last 30 years, the average CAGR salary increase is 5.37. In the private sector, it is in the range of 9 point something. So that in 2 to 3 years time makes you comfortable, and you are able to take care of your savings and prepay the loan in time, which is the normal 7 to 11 years. So that is a big advantage for the borrower, because once you move to a 30-year loan, so instead of paying maybe 1 lakh rupees per month on a 1 crore loan, or a 50,000 rupees on a 50 lakh loan, your EMI significantly comes down to maybe about 35 or 35,000 or something, which makes it very affordable. There are two things which happens because of this. The borrower is either able to go to a better builder with a better reputation of delivery, or he goes and buys a slightly bigger. So maybe he was buying a 2-bedroom, he goes and buys a 2.5-bedroom, with a study, or he upgrades to a 3-bedroom house, and he leverages his income to the max of 50,000. So he gets a higher loan amount, and his installment remains 50,000. Or if he takes the same amount, then the EMI comes down to maybe 35,000. So it's a win-win situation for that segment as well. So this is one dimension that is there for mid and high income. The other dimension is that even in the middle and the high income segment, invariably, there are other sources of income. There are, your parents are staying with you. Your parents have not retired, so there is some income, or parent is in a government service, so there is a pension coming. The spouse is working as a teacher in some small school, getting salary in cash. Those kind of other income. There is maybe there is a vehicle which you have leased out for somebody to run the car, or a small bus, etc. Those kind of many other businesses are also run by mid-income and high-income people, which or you have a rental income which is coming from your ancestral home or your father's home. So those incomes are also considered for mid and high income, and we therefore are able to increase the debt to income ratio and increase the loan amount. So that same principle applies here as well. And that is how we service the mid and high ticket borrowers as well.
How much is the cost of mortgage guarantee? Say if I take a 75 lakh or a 1 crore loan, then about how much would I end up paying for this mortgage guarantee benefit?
The average cost would be in the range of 1.2% of the loan amount for the life of the guarantee, which could be, if you're taking a 30-year loan, 1.2% for 30 years. But if you break it down to an annualized basis, because everything is on an annualized basis, your interest cost, etc., is all on an annualized basis, it will work out to 20 paisa or 25 paisa per annum. Now, that is still a significant saving for you. If I take you from maybe a smaller lender like Shubham, Aadhar, Vastu, Housing Finance, which is lending at maybe 11, 12, 13%, and get you a loan at 100, 200 basis points, the cost is just 20, 25 basis points per annum. So it makes perfect sense. And this question has been asked by a lot of lenders to us, saying, will the borrower pay up? Now, the good thing about India is that the borrowers, unlike what the lenders would like to believe, and unlike what anybody else would like to believe, the borrowers are very smart. They weigh all the options. So people have multiple options of taking loans from various lenders. They do their commercials, they do their math, and only when it makes sense, commercial sense, that by paying this 1.2%, that is also paid on a monthly basis. Nobody pays upfront. It is deducted from your loan amount, and it is made into an installment. So they do their math, and everybody. So there is the proof of the pudding is that 100,000 families have already paid the guarantee fee. So this this view of the lenders and some of the borrowers or some of the people who have actually looked at the product have always questioned this. But I think that the proof of the pudding is the fact that we've done 100,000 guarantees to 100,000 families, and majority of this, 86% of this would be in the affordable segment.
And how do I avail of this product? Do I approach IMGC or do I approach one of the lenders to get mortgage guarantee? And can I only get it from a few lenders? What is the situation?
Yes, that unfortunately is true as of now. That's the model that was there globally for mortgage insurance as well. And therefore, we have a B2B model where we tie up with a lender and offer the product. Therefore, you will have to go to a lender partner as of now. But we are also dabbling with the idea of going directly to the consumer, because the consumer ultimately has to be educated. What is currently happening is that while we have a tie-up with lenders like Axis Bank, LIC, so the top 5 lenders, ICICI, HDFC, Axis Bank, LIC, they and State Bank of India constitute 65% of the total mortgage market. So we work with 3 of them as of now, and we are in the process of signing up with HDFC as well. The lenders have not been propagating the product as much as we would want them to. It is basically what is coming through, and they are not able to process them because of their credit box being small. So then they use our expanded credit box to ensure that those loans which have already come in fit the bill, and they are able to give them loan. So there is no wider publicity of the program by the lenders, which is happening, saying, yeah, look, we are doing these kind of loans also. And therefore, the sales channels, aggregate them and get them to the lender partners that we have. So we're dabbling with the idea, and maybe in due course, we probably will start going directly to the borrowers as well, and get them to the better lender partners who are willing to offer at the lowest rate. So we will ensure that the lenders who offer the best rates and commercial terms to the borrowers, who are otherwise not coming into the fold and going into these small HFCs or non-banks or private lenders, they come into the fold. So we will toy with that idea. It is an expensive idea because you need people and resource, and the fees we can't increase much because we don't want it to become unaffordable. We want it to be at the minimum. So but we definitely will consider in future, if required, to go to the people directly and start if required.
So as the situation stands, people have to themselves go to the lender and ask for this product. That is the current situation.
Yeah, the current situation is that they will have to, while most of the lenders have branded the products that they have with guarantee as separate. For instance, LIC calls it Gri Suvidha. They do advertise, but maybe it is not enough. It is still what is coming through is what is getting processed. But we probably need to do more. The lenders need to do more to educate the people about the availability of this product. Yeah.
Now, one question around home loan rates. They are at or near peak levels, and for a lot of borrowers, the banks or lenders can't increase the EMI. Now they are increasing the tenure because of the increase in interest rates. What would your advice to existing borrowers be? What can they do to deal with this situation of higher home loan rates?
Well, unfortunately, bulk of what is lent is variable rate loan in India. That is because bulk rates are cheaper. Fixed rate loans are not available because the debt market in India is at a very nascent stage. Long-term debts are not available. Long-term cheap debts are not available. So there is no option for the lender but to offer variable rate, which invariably passes on the risk of interest rate volatility onto the borrower. While the interest rates are low and borrowers are happy, but once it starts going up, it adds a risk. Now, the problem is that there is a limit to which you can increase the tenure. If the interest rate increase is maybe 25, 50, 75 basis points, then it gets, or maybe 100 basis points also, it gets managed by way of loan term increase. And eventually, over time, because if the interests are going up, it will come down also because it is cyclical. In any economy, the interest rates will go up and go down over time. So on an average, your original contracted tenure is almost the same as what it was. But when the interest rate shoots up like this, 225 basis points is what it was already since April of this year.
250.
So, the ability to increase the loan tenure is not there, because what happens is that if you increase the tenor, then the interest that you have to pay in a month becomes less than the equated monthly installment. Therefore, the lender is left with no option but to increase the EMI. That, unfortunately, there is no escape. You will have to muster in that higher EMI. And with the inflation, unfortunately, interest rate hike is always accompanied by inflation as well. So you have to take care of your other expenses as well. Now, the only option which is left is that if you're in a tighter situation, is to make small amounts of prepayments, because the regulations by Reserve Bank of India and National Housing Bank have prohibited any kind of penalty if you prepay whatever 2%, 5% of the loan outstanding. So even if you have 100 rupee outstanding, even if you have saved 22 rupees, 5 rupees, you should go and pay that up. By paying the principal, they will re-amortize and reduce your EMI, make it manageable for you. That seems to be the only option. We should be thankful that we've not had a 8% and 11% inflation like what Europe and US is seeing. And I hope it remains this way and the global headwinds don't change much. We don't see more escalation of geopolitical tensions, and which results in commodity price increase. I just pray and hope that that doesn't happen. But there is this risk, and we would advise, my sincere advice to all home loan borrowers who are facing this problem is to save as much, cut down on your discretionary expenses. Whatever little that you can save, go up and prepay. You are allowed to prepay as many times as you want. So every month, even if you're able to save something, you should go and pay that amount and reduce your EMI burden.
I have come to the end of my questions, Mr. Shrivastava. Thank you so much. It has been a pleasure speaking to you. I have learned a lot about the concept of credit guarantee, and I sincerely hope that this concept catches on in our country. Thank you and goodbye.
Thank you so much. Thank you so much.
Have a good day.
Have a nice day.